Well, it was all about the banks today and other defensive stocks like Telstra and CSL. The bank index has outperformed the resources index by 40% over the past 12 months as investors look for safety both in the bank and in bank shares. Over the past 2 months, the All Ordinaries has been flat, but banks went up 6% and resources went down 6%. Money is pouring into bonds and cash as well because the usual gap between their returns and shares has disappeared. This chart shows the rolling 10-year returns from cash, bonds and equities or shares. For the first 90 years of the 20th century, shares usually produced double the returns of fixed interest to compensate for the extra risk. In the past 10 years, the returns have converged, so you're not getting any compensation for the risk of investing in shares, which is why stockbrokers are going broke. Here's what happened on global markets these past 24 hours. Not much is the answer. But there's a very interesting gap in the performance of Chinese and American shares over the past 3 years. US companies in the S&P 500 have gone up 44%, while Chinese companies have gone down by nearly as much. But hang on, China is supposed to be the growth market and the US is mired in debt, all washed up. Well, yes, except Chinese labour and energy costs for companies are rising rapidly, whereas in America, labour costs have been flat and energy costs have been falling because of all the shale gas they've found. On commodity markets, wheat and other crops are continuing to surge because of the big American dry. Oil seems to be heading back to $90 a barrel and base metals were mixed. And finally, the Australian dollar is sitting right on 103 US cents, which it hasn't seen since early May. And that's finance.